other form. I think now we can proceed and do what is required in part 1 and also part 2 of that question. So we start with part A. In part A of that question, we are required to prepare the statement of comprehensive income. So mean that first of all, we need to have the title. So the name of the company is Cpa Limited, and this is a statement of comprehensive. The statement of comprehensive income, which is for the year. For the year which ended 31st March 2019. So when preparing now the statement of comprehensive income for publication purpose, we just need to have one column like that. And here we always start with the revenue. We start with the revenue, or basically the income of this company. No adjustment as far as that is concerned. And we have that in the trial balance as an amount of 649,940. 649, that should be 440. 440. And then now to this, we less the cost of sales. The cost of sales. Now, the cost of sales here will be having a number of adjustments, but I think what we need to do is to take the cost of sales which we have in the trial balance. In the trial balance, we have the cost of sales, where we have the investment income that is given as 321, 120, 120. And then there are a number of items here which now will be adjusted to the figure for the cost of sales. So if we go through the workings now which we have here, we have a number of items which will be adjusted in the cost of sales. In working 1, it is about finance cost. This will not affect our cost of sales. Working 2 is about light issue. It will not affect the cost of sales. Still working 3. But working 4 here, we do have part of the depreciation on buildings, which now will be classified, or basically should be included as part of the cost of sales, and that is an amount of 10,800. Still, we have this depreciation on plant. First of all, before we make the adjustment, we are told that there is this cost of the cost of the new plant, which was included in the past of the in the cost of sales, and basically you have said that that is wrong. So therefore, what we need to do from that figure, we need to less the cost of the new plant, that is 86,400, and then now we add, or we include now this depreciation on a plant, which is 48,600. So we add 48,600. Yes, and then now we get now our figure for the cost of our sales. So let's compute that amount. So we have 321, 120 plus 10,800 minus 86,400, and then plus 48,600. Yes, that now will give us the cost of sales of 294, 120. So we let's start from our revenue to get the gross profit. Now our gross profit will be equal to our revenue, 649, 440, and then we less that we less the cost of sales, which will give us 355, 320. So that is now the gross profit. Now once we get the gross profit, we are supposed to check any other form of income, and we add it now to our gross profit. Now if we go back to the trial balance which we have there, I think we have a number of incomes, and basically the incomes, we should check them on the credit side of the trial balance. The first item on the credit side is accumulated depreciation. That is not an income. And then below that we have investment income. Investment income is part of other income, so we add that now to our gross profit. Investment income, and that is an amount of 7920. And then below that we have income tax liability. These are the tax which are not being paid by the company at the end of the year. We have revenue, we have ordinary shares, retained earnings, debentures, payables, revaluation, reserve, suspense, and then we have bank. So mean that in our case here, we don't have any other income. So we need to add the two so that we get the total income. So let's add those two figures. We have 355, 320 plus 7920, and that will give us a total income of 363 240. And then now to this we need to less the expenses. We start with the administrative expenses. Expenses. So for the administrative expenses, we need to take what we have in the trial balance. The administrative expense we are given in the trial balance is an amount of 45,000. Yes, 45,000. 45,000. We can confirm that. Yes, that is an amount of 45,000. And then there is a part of depreciation on buildings here, which is to be classified as part of administrative expense, and that is now the amount of 36. So we add 3,600 there. And I think no any other item here, or basically no any other note or working, which will affect that. Working 6, in fact, you have dealt with that. Working 5, working 4 is 36, which should be added to that. Working 3, working 2, and then we have working 1. Yes, so that is the only item now which will be adjusted now to our administrative expense. So that will give us a total of 48,600. So that should be deducted now from our total income. And then from there we have the distribution cost. So the distribution cost, first of all, we have the figure which we have in the trial balance. That is 39,600. And part of the depreciation on buildings, still an amount of 36, is to be added to that. Yes, and I think that is the only adjustment, because this will not be affecting distribution. The same case with that. This is an amount of 36, note 3, note 2, note 1. Yes, so let's get the total amount there. So we have 39,600 plus 3600, and that will give us 43,200. And then still to this we take into account the finance cost. So we need to check whether we have any finance cost in the trial balance. And I think in the trial balance we don't have any finance costs. There. So the only finance cost we will be having is what we computed in note number 1. We computed a finance cost here of 8640. 8640. So we have that here. 8640. Yes. So, and then in our case, I don't think there is any other expense we have not included in our statement of comprehensive income. Maybe just to counter check that, we have dealt with the working 1. Working 2 is about late issue, do not affect any expense. This will affect OCI, other comprehensive income. We have dealt with all these depreciations there. We have dealt with that, yes. And maybe also in the trial balance we can check whether we have any other expense we have not dealt with. And I think, no, we don't have any other expense. So what we need to do is to get the profit before tax. Now, our profit before tax will be given by the total income, that is 363,240, and then we less those three expenses, 48,600 minus 43,200 minus 8640, and that will give us now a profit before tax of 262,800. Now, to this, we are supposed to less the income tax expense. income tax expense. And the income tax expense which you are going to less here is what you are given in note 2. In note 2 we are told that this company was to make a provision of 61,560. So that what should be deducted now from our profit before tax. So we less 61,560, and that will give us 201,240. 201,240 is the profit for the year. For the year. So once now we get the profit for the year, we are then supposed to proceed and we add OCI. We are supposed to add the other comprehensive incomes. And in our case here, we do have two other comprehensive income. First of all, we have the revaluation gain as far as the buildings are concerned. Not revaluation gain, rather a revaluation loss. A revaluation loss on buildings, or basically we can refer to that as PP, because buildings is part of property, plant and equipment, which is 10,800. So being a loss, we take it as a negative, and then still we have this revaluation gain here on AFS. The revaluation gain on AFS is an amount of 21,60. Still, that will be part of OCI. So we have revaluation gain on AFS, which is an amount of 2160, and being a gain, we add it, and then we get the total comprehensive incomes. The total comprehensive incomes. So we add all that. We have 21240 minus 10,800 plus 2160. So that will give us a total comprehensive income of 182,600. Yes. So that is now the end of our statement of comprehensive income. So we move to Roman 2. In Roman 2 of the question, we are required to prepare the statement of financial position of the company. So we have the title, Sobea Limited, a statement of financial position, and this is prepared as at the end of the year, that is as at 31st March 2019. So in our case, we need to have two columns here, like that. And we start with non-current assets. Now, for the non-current asset, in our case, we have a number of non-current assets. If we go back to the trial balance, we have, first of all, land and buildings. We have plant. Now, what we need to note is that when preparing now the statement of financial position for publication purpose, those tangible non-current assets are not supposed to be taken there separately. Rather, what you are supposed to do is to get their total net book value at the end of the year, and then we refer to them as PP, that is property, plant and equipment. Because when talk about now the PP, these are the tangible non-current asset. So what we are supposed to do is, first of all, as far as the landed buildings are concerned, there is some information which you are given in note 3, not note 3, sorry, but note 5, and we did some workings here. First of all, we have the value for RAD. The value for RAD is 108, and basically we are told that according to the valuation which was done at the end of the year, the value for RAD remains the same. So the value for RAD will remain as 108, but we are told that the buildings were revalued now at an amount of 331,200. So we are going now here to include the value for RAD as per the valuation which was done at the end of the year, that is 331,200. And then we also need to include the value for plant, because we have included the value for RAD and buildings. Now, for plant, first of all, the value for plant which we have in the trial balance is 460,800, and then now to this we need to less the depreciation at the start of the year, which was 115,200, and also to this we less the depreciation for the year on plant, which we have here, and that is 48.6. Now, whatever you are going to get will be the total net book value for all tangible non-current asset, and which now in a single term we refer to as the property, plant, and equipment. So let's compute that amount. So we have 108,000 plus 331 200 plus 460 800, and then minus 115,200 minus 48,600, and that will give us a net book value of 37,36,200. So therefore, when preparing now the statement of financial position for publication purpose, then the non-tangible assets should not be included there separately. Rather, what we should do is we should get the total net book value for all tangible non-current asset, and we include it here as PP. Then we need to check whether there is any other asset which will be included here, and in our case we will be having a available for sale investment. Now, available for sale investment, these are investments which are to be held for a long period of time, and therefore these are classified as part of non-current asset. And I think as per note number 4 is that we are told that this investment were valued to the fair value at the end of the year to an amount of 97,560. So therefore include them there at their fair value at the end of the year, and then from there we check whether we have any other non-current asset. I think in our case we have dealt with landed buildings, plant, AFS, and in our case I don't think we have any other asset, because any other asset which we can include here, or the other asset we can include here, are intangible assets, and in our case we don't have that. So what we need to do is we get the total, we add that, we have 736,200 plus 97,560, that will give us 833,760, and then now to that we add the current assets. Now for the current asset, I think we can first of all go through the additional information. We check whether there is any additional information which will be affecting current asset. Note 1 is about debentures, that is a non-current liability. Note 2 about tax, that will not affect current asset. Note 3 is about light issue. Note 4 we have dealt with that. Note 5 we have dealt with that, and still note 6 we have dealt with that. So mean that none of the additional information will affect now our current asset. So let's go back to the trial balance. We check which current asset we have, and the first one is trade receivables. Trade receivables is an amount of 126,360. Above that we have inventory at the end of the year. That is a closing inventory which was 136,440, and then above that we have debenture interest, that is not an asset. Administrative distribution costs, then we have, yes, I think we only have those as the only current assets which we have. So and then we get the total, we add the two, we have 126,360 plus 136,440, and that will give us 262,800, and then we add that to the total non-current asset, which is 833,760. That will give us 10,96,560. So those are total asset in our case. Total assets, and then we say that the total assets are financed by both the capital and liability. So we start with the equity. Equity, this is ordinary share capital and reserves. Now let's start with the ordinary share capital. Now the ordinary share capital which we have in the trial balance, ordinary share capital which we have in the trial balance is an amount of 216,000. But this will have now to change because there was a right issue which was made by the company as per note 3, but the company had not credited the shares which were issued in the ordinary share capital. Now we have done workings as far as that is concerned in working 2 here, and we determined now the shares which were issued during the right issue. We said the amount which will be added or which will be credited in the ordinary share capital is an amount of 54 and an amount of 32,400 to be credited in the share premium. So therefore, this will increase with an amount of 54,000. So we can add those two figures. We have 216 plus 54. That will give us 270. 270. And then below ordinary share capital, you have retained earnings. Now the retained earnings at the start of the year was 91,800, and then now to this we have to add the profit for the year. The profit for the year in our case was 240, and if at all maybe there are some dividends which were paid, we are also supposed to less them from that figure. And in our case, we don't have dividends which were paid in course of the year, so mean that the dividend for the year was 0. But if there were some dividends which were paid, that should be deducted from the figure for the retained earnings. So we have 91,800 plus 201, 240. Yes, and that will give us 293,040. Yes, so we have that, and then we check whether we have any other component of equity. And below the retained earnings, we have debentures. Those are non-current liabilities. Trade payables, that is a liability, a current liability. But below that, we have a revaluation reserve. A revaluation reserve for landed buildings or a revaluation surplus. Now, the revaluation reserve at the start of there was 50,400, but that will have to be adjusted because in course of the current financial year, we had a revaluation loss. I hope you can remember here we computed the revaluation loss in respect to buildings, which was 10,800. Now, that 10,800, because it is a loss, it will reduce that surplus. So we less it from that figure, and we get now the net revaluation reserve. So we have 5,400 minus 10,800, and that will give us 39,600. Yes, that's what we have. And then below that we have suspense bank. So, but equally, as far as our note or our working 2 is concerned here, there is something we have to remember to include there, and that is a share premium. So the share premium of 32,400 in respect to the right issue which was made, that will be part of the equity, part of equity, which was 32,400. Yes, we have that, and still there is also something else we are going to include here, and that is now this revaluation gain as far as available for sale financial asset are concerned. Still, that will be included here, and it will be known as AFS revaluation reserve. Revaluation reserve, and that is an amount of 2160. So I think those are the only items of equity which we will be having, there. So we get the total. We add all that. So we have 270,000 plus 293,040 plus 39,600 plus 32,400 plus 2160. That will give us an amount of 637,200. So that is total equity, total owner's equity, equity. And then now to that, we should then proceed and we add the liabilities. So I think we can have now our liabilities here. do away with that. We have our liabilities here. So for liabilities, we start with the non-current liabilities. Non-current liabilities. So for non-current liabilities, first of all, we have the 4% debentures. 4% debentures. And still, we also have to remember what we did in working one. In working one, we computed now the amortized cost for debentures, and which we said there will be the amortized cost for the debentures at the end of the year, which is 293, 760. And then we can also check whether we have any other non-current liabilities. All liabilities do have a credit balance, so we check the items on the credit side of the trial balance. Yes, and I think that is the only non-current liability we will be having. And then finally, we have the current liabilities. Current liabilities. Current liabilities, let's start with maybe additional information. We see whether there is any additional information which will affect that. Note 1, we have dealt with that. Note 2, note 3, note 4, 5, 6. So meaning that we don't have any current liability being affected by the notes. But if we go back to the trial balance, we start with the last item in the trial balance. Now the last item in the trial balance, we are given a bank, but that bank we need to know it is an overdraft simply because the balance is on the credit side. So being on the credit side automatically means it is an overdraft. So that is an amount of 23,760. Above that we have suspense, we dealt with that revaluation. And then above that we have trade payables. Trade payables. Now the trade payables in our case is an amount of how much? Is an amount of 124,920. And then we have debentures, that is non-current liability. We have retained earnings, ordinary share capital. And then above that we have income tax liability. When talk about the income tax liability, this is the income tax which the company had not paid at the end of the year, which is 41,760. Yes, 41,760. Yes, and I think those are the only current liabilities which we have. So what we need to do is to get the total. So let's add all that, the total current liabilities. So we have 23,760 plus 124,920 plus 41,760. That will give us 190,440. So then we need to add what we have there, the current liabilities plus the non-current liabilities, 293,760. And then plus equity, which is 637,200. Okay, let's take that again. We have 637,200 plus 293,760 plus 190,440. Yes, and that will give us a figure of 560, which now will be the total capital and liabilities. Total capital and liabilities. Yes, so that basically what was required in that particular question there. And the question generally was testing on the concept of the preparation of the published financial statement, which is one of the common topic in financial reporting. So we take a short break and then we come back, we look on the other question.
So let us look at allowable legal costs. Allowable legal cost number 1 is the legal cost for a lease, not more than 99 years. 99 years. So when you're doing your business and you decide you want to occupy a property, let's say a building, and that building you are going to occupy for 99 years, 80 years, 70, 10, 5 years, 1 year, and you decide to make it legal, you require a lawyer to help you in preparing that lease. And that lawyer even sign that document of the lease. And you pay for that service. That is what we call legal cost for a lease. As long as it's 99 coming down, that is a allowable expense. And that means if the lease is for more than 99 years, it can be 99 and a half years, 100 years, 105, 120, 150 years. That legal cost is not allowable. You cannot deduct it against the taxable incomes of the business. Number 2, we have legal costs for preparing staff contracts. That's another one. That in your business, when you are hiring your staff, some of your staffs may tell you, I want you to make this agreement legal. And so you will have to hire a lawyer. In the process of hiring a lawyer, they charge you some fee and you pay. When it comes to the taxation of your business, that you are allowed to deduct that legal cost when you're determining the taxable incomes of the business. After that, we have the third one. We have legal costs relating to customers and debtors. Although debtors are your customers, but it's good to specify, because most of the time you find that those legal costs normally relate to the debtors. A good example, a debtor has refused to pay you what they owe you. So you decide to take the legal process. You go to a lawyer, ask that lawyer if he or she can prepare for you a demand letter. You take to that customer to notify them that you're going to take a legal process. And now that lawyer writes for you that demand letter, but charge you like 3,000, 10,000. When it comes to the determination of your taxable income, you'll be allowed to deduct that legal cost against your taxable incomes of your business. Number 4, we have legal costs to list a company at stock exchange. We normally have what we call listed companies or quoted companies. These are companies whose shares are traded at stock exchange market. In Kenya, we have Nairobi Stock Exchange Market. That means anybody who may want to become a shareholder of that company just need to go there and you buy shares of that company. It's open. When that company was getting there, it could have incurred several costs. One of them was to hire a lawyer to help them in preparing the document for presentation to, for example, Capital Market Authority, for them to be allowed to, for their shares to be traded there. That legal cost they paid when they were getting there, it's supposed to be an allowable expense. Number 5, legal costs to defend property rights. It means you have, for example, land somewhere. You own that land. Or you could be owning a motor vehicle. Somebody from outside just come and say, this land used to be mine. This motor vehicle used to be mine. It was stolen from me. This building used to be mine. You decide, no, I bought these items legally. So you decide, let us go to court so that the judge can decide who owns these items. And because you are not a lawyer, you hire one to go and represent you. In the process, he charges you some legal fee. That is the one we are saying legal cost to defend your property. And when you pay, that become an allowable expense. The last allowable legal cost, number 6, is the legal cost relating to tenders. Tenders relate to your business. For example, you want to supply something to your customer. They tell you you have to tender. But maybe because you don't know the process of doing that, you hire a lawyer. Come and help me prepare these tender documents. They charge you some legal fee. That legal fee is supposed to be allowable. So these are the allowable legal costs. While still under the legal costs, I want us to also look at non-allowable legal costs. Non-allowable legal costs. It is the opposite of the allowable legal costs. That these are the costs or expenses which cannot be deducted against the taxable incomes of the business when you incur them. They are which one? Number 1, we have legal costs. Legal costs to purchase or transfer a fixed asset. The other name we normally give that cost is the conveyance fee. Why don't we allow it? Because here we said the legal costs we allow are the ones that are revenue, that the benefit can be realized within a year. The one that benefit extend beyond 1 year, we don't allow. Fixed asset is one of the item where you enjoy benefit for a period that is more than a year. So when you are purchasing, selling, you incur some legal costs that you're not allowed to come and deduct it against the taxable income of your business. That cost is also called conveyance fee. This is very common. So it is usually not allowable expense. It is related to the fixed asset. It's not allowable. We have number 2, legal costs to defend. To defend a crime. So what we saw, legal costs to defend your property is allowable. But if you commit a criminal activity and you're taken to court, you hire a lawyer to defend you, that legal cost will not be allowed by the taxman to come and deduct it in the business. Why? Because it is not business related. You are not doing business. So that is usually not allowable. Number 3, legal costs relating to bank loans, bonds, and debentures. Now we are talking about legal costs relating to bank loans. Why don't we allow them? Because loans are long-term financing. That when you take a loan, the bank will tell you to pay after 8 years or within a period of 8 years, 10 years, or even some others go to 15 years. So it's a long-term item. So the legal cost you incur when you're taking that loan is usually not allowable. Same case relate to bonds and debentures. When you hear companies issuing bonds, issuing debentures, they are taking loans from the members of the public. And being loans, they are long-term. They will tell you they will pay you after 10 years or within a period of 10 years, 15 years. So the legal costs in the process of issuing those debentures, bonds, are usually not allowable. After that, we have number 4. Legal costs relating to memorandum of association and partnership deeds. Partnership deeds are also called partnership agreements. What is the memorandum of association? In law, we normally consider that as a constitution of the company, that it is the document that guides the company in the long term. So being in the long term means if the company lasts for 25 years, that memorandum of association will be there for 25 years. So it's a long-term document, not revenue. We call that capital expenditure. Partnership deed or agreements, the same. These are agreements that are signed between partners. And this agreement will be there in the partnership as long as the partnership is there, guiding the partnership, how they are supposed to operate. So it's a long-term document. So we don't usually allow based on that. After that, we have number 5. Legal costs relating to patents, copyrights, and trademarks. Now, legal costs relating to patents, copyrights, and trademarks. Now, this in financial accounting, we used to consider them as intangible assets. Intangible assets used to be classified under fixed assets, long-term assets. So you can see the reason why we don't allow them, because they are long-term, capital, and not revenue. So legal costs you incur relating to that, or those ones, are usually not supposed to be allowable. Another non-allowable expense, legal costs, number 6, is the legal costs relating to breach of contract. That or contract. That if your business break one of the contract you have with your trading partners, be it customers, suppliers, be it staff, and they take you to court, and the court determine that you actually broke that contract, and actually sometimes we are going to see they fine you, that is not supposed to be allowable because you're not supposed to be breaking contracts. Another one, number 7, legal costs relating to tax matters. Yep, we are going to learn. Another one is that sometimes the KRA, taxman, can, for example, assess you and tell you are supposed to pay a certain amount of tax, but you're not satisfied with that. You decide to appeal or even object, but you don't want to do it directly. You hire a lawyer to come and help you in your defense. That legal cost you pay there is not supposed to be allowable. And this we are going to learn. It does not just restrict itself to the tax matters or legal costs relating to tax matters. It also says that all other expenses, as long as they are connected to tax, they are usually not supposed to be allowable because it's assumed you are the one who is supposed to handle your own tax issues. The last one, number 8, court fines and penalties. Now, when you talk of court fines and penalties, when you are fined, it means that you are the one who was on the wrong side. So it means that is not supposed to be related to the business. You did something that was outside what you are supposed to do. So when you are fined, you pay that fine. It's connected to legal matters. That is usually not supposed to be allowable. So these are the allowable legal costs, the non-allowable legal costs. But don't forget, we are still under the allowable expenses. Only that the legal one normally have several allowable and also non-allowable, and we had to look at them. So we go back to the list of the allowable. After number 5, we have number 6, another allowable expense of the business. Number 6, payment to trade associations. Now, to differentiate this allowable expense numbering, as you can see, we have number 6 here. From this allowable legal cost and unallowable, let me rename this one as A, B, C, D, E, and F. Same case here. A, B, C, D, E, F, G, H. Yeah. So that is just the numbering so that you can differentiate this continuation here from the legal costs. Now, back to number 6, payment to trade association. As the word say, trade association is an association that is related to your trade. What do we mean? For example, if you are operating a bank, they normally have an association called Kenya Bankers Association. It is there to improve the banks, help to fight for the interest of the banks. If you are in manufacturing, there is an association called Kenya Association of Manufacturers. It is there to trade and protect the interest of the manufacturers. So when a business pays to this association, it is helping to strengthen them, to help them fight for their interests. So that amount is supposed to be an allowable expense. Number 7, another allowable expense is the employer contribution on behalf of employees to pension schemes and provident fund. Which are these schemes? Pension scheme or provident fund is where employee and sometimes the employer make a saving for the retirement of an employee. A good example, in Kenya we have NSSF. When you contribute to NSSF, according to the law, the employer is also supposed to contribute similar amount for you. But when they do that, the time of their taxation, they will be allowed to come and deduct that amount against the taxable income. So that is an allowable expense. Number 8, research costs. Research costs and payment to research organizations. Research costs. If you are in the business, for example, you want to introduce a new product. Before you do that, to increase the chances of it succeeding, you need to do some research. What do the customer want? Are they okay with what you are giving them? In the process, those research costs you incur, at the time of taxation, you'll be allowed to come and deduct them against your taxable income. Same case, research payment to the research organization. A good example, if for example a farmer make a contribution or donation or payment to KEFRI, Kenya Forest Research Institute. So what do? They carry out research on the best, for example, trees that farmers can be able to grow and get maximum benefit. So when a farmer contributes to them, that is supposed to be an allowable expense when it comes to the year taxation. So research costs and payment to research organization. Number 9, we have advertisement expenses of revenue in nature. So the key thing there being advertisement expense of revenue in nature. Revenue, we said these are expenses you incur and the benefit is realized within a short period of time, usually within a year. So when it comes to the advertisement, you may find advertisement on radios, TVs, newspapers, preparing brochures. When you advertise in them, it is usually assumed, for example, when you advertise on radio, the customer can already remember what you have advertised within probably 2 weeks, 1 month. After that, they might forget what you advertised unless you continue advertising. So it's revenue within a short period of time. Those are allowable expenses. But it is important to note that capital advertisement expenditure are not allowable. You can put that. You note that capital advertisement expenditure are not allowable. Capital expenditure, we said, these are expense where you incur an expense, but the benefit you derive over a long period of time. It is the opposite of revenue. A good example is construction of a billboard, construction of a signpost, construction of neon signs. These are long-term advertisement items. When you put a billboard somewhere or a signpost, it advertises you for 10 years or even 5 or even 50. Some are there forever unless you do rebranding. So the cost of putting them up there is not allowable. What we do for them, we claim the capital allowance we talked about here. And we are going to learn, we claim the capital allowance we call wear and tear allowance, whose rate at the moment is 10%. So you take 10%. So if you construct a billboard for 100,000, first year you take 10% of it, 10,000. Then when you get to the second year, another 10%, but we're going to learn it's usually on a reducing balance. The third year, 10% that way, but on a reducing balance. So capital advertisement expenditure is usually not allowable. Then we go to number 10. Number 10. Number 10 of another allowable expense is the employer contribution on behalf of employees to members club. But that members club must be related to employees' work. Employer contribution on behalf of employee to members club. A good example of this is accountants. For you to be a fully recognized certified public accountant of Kenya, you must be a member of ISPAC, even when you are done with your CPA. When you become a member, you will note every year you have to contribute something we call subscription fee. Now, when you get employed, the employer may tell you, I'll be contributing that for you. Every year, I'll be contributing that for you. Because it is related to your work, that will be allowable when it's determining the taxable income. Number 11, we have realized foreign exchange loss. So, when you are looking at the incomes, we had specified that realized foreign exchange gain is a taxable income. Unrealized foreign exchange gain, an untaxable income. How about in case a loss is generated? If it is realized, it is an allowable expense. If not realized, it's usually an unallowable expense. Number 12, another allowable expense, donation to charitable organizations. That is supposed to be another allowable expense. Question is, which are these charitable organizations? According to the Income Tax Act, it specifies that they include any organization that advances religion, education, or to alleviate the poverty in the society or suffering in the society. If you look at that definition, religion, we are talking about churches, mosques. When you talk of education, we are talking about schools. When you talk of alleviation of poverty or suffering, we are talking about like Red Cross. We are talking about NGOs. So when you make or your business make a donation to them, that is supposed to be an allowable expense. And this we are going to learn. Any other donation is not supposed to be an allowable. Any other. So if you find donation to a political party, that is not supposed to be an allowable expense. A general donation, that is not allowable expense unless it is specific, it's to a charitable organization. Number 13, we have interests on money borrowed and invested in business. That if a business take a loan from a bank and that money is invested in your business, the interest you pay every year, every period, that's supposed to be an allowable expense in that particular year. And we saw that there's another form of loan, usually taken by the limited companies, debentures. When a company issue debenture, or bonds, when a company issue bonds, these are forms of loans. So when they pay interest, those interests are supposed to be allowable expenses. After that, we have number 14. Payment to directors of a company for service rendered. That's supposed to be a allowable expense. Directors are considered to be employees of the company. So when you pay them director salary, director's fee, director commission, allowances, all these are supposed to be allowable expense because they have rendered the services to your business. So these are the allowable expenses of the business, and this is according to the Income Tax Act. You get them there. After looking at the allowable expenses, we need to look at non-allowable expenses. These are expenses which cannot be deducted against the taxable incomes of the business. Which are these non-allowable expenses? We have number 1, non-revenue stroke capital and non-commercial expenses of the business. That is number 1. This is actually the opposite of what we saw in the allowable number 1, where we said all revenue and commercial expenses of the business are allowable. And we explained. And we said these are 2 broad terms. Same case here. These are 2 broad terms. And when we talk of non-revenue or capital, these are expenses of the business where the benefit is realized over a long period of time. A good example is the costs of a motor vehicle, a fixed asset. You purchase a fixed asset, you don't use it with 1 year and that is over. You use it 1 year, 2nd year, 3rd, 5th, that way. So its cost is not allowable. What we do with it, we said, is to claim a capital allowance which we said is supposed to be allowable expense. The other one is non-commercial. Non-commercial, we said these are expenses which are not related to the business activities. A good example, we said private expenses of the owner, like rent expenses of the owner at home, electricity expenses of the owner at home, salaries and wages to the house help, gardeners at home. These are usually not allowable because they are not commercial, they are not business related. So any expense that you come across that is non-revenue or capital, that is non-commercial, know that that is not supposed to be an allowable expense. Number 2, we have non-trade, bad debts written off. We said trade bad debts written off is allowable because you are writing off a debt relating to the business trade. Like when you sell goods on credit, they refuse to pay. That's allowable. But those that are not related to the business, for example, you had sold a fixed asset, you had lent money to your customer, your staffs, your relative, they refuse to pay, and after 4 years you decide to write them off, those you cannot be allowed to deduct them against your taxable income of the business because they are not related to what you do on a daily basis. Number 3, general provision for bad debts. The other way to put it is increase in general provision for bad debt. We had said if it is specific provision for bad debt or increase in specific provision for bad debt, that is allowable. General provision, we said, normally arises as a result of estimation. So when you compare general provision at the start and at the end, and you find that they have increased, for example, at the start 20, at the end 25, that year it means that you created 5 million more. That is not supposed to be allowable against the taxable incomes of the business. Number 4, we have depreciation. Depreciations are usually not allowable. And we said depreciation is an expense related to the accountants. In taxation, we don't recognize that. Instead of depreciation, we recognize the capital allowances. So depreciation is not allowable. Number 5, we have the costs of fixed assets. Although we had said or mentioned that under the cost of fixed assets, so this is an unallowable expense, and we said we had mentioned this one here, that capital expenditure or non-revenue expenditure are usually not allowable. Reason, they are long-term costs. So you benefit out of them in the long term. So we don't usually allow them. Number 6, we have loss on disposal of fixed assets. Fixed assets. That when you dispose your fixed asset, like if you have motor vehicle as a fixed asset, furniture as your fixed assets, and you dispose them in the course of your business, if you generate a loss, it's usually non-allowable. And actually, if you remember, we said when we were looking at the incomes of the business under non-taxable, we said income or profit from the selling of fixed assets, we don't tax because these are not the items that you deal with in the business. So you make a profit, don't tax. You make a loss, don't allow it. Don't deduct it against the taxable incomes of the business because these are not the items you deal with in the business. They are not stock. They are not goods. Number 7, we have loss on disposal